Welcome back. This video will cover two short chapters: individual health insurance market and the high-risk pools. Also, let me say I apologize for the sound quality. I'm recording directly to the computer and I don't have a microphone today. So let's go ahead and get started. Coming up at the end of the week, so there's not a lot of Power of Three terms. But if you want to take this up on the Power of Three, please discuss the Affordable Care Act and the exchange markets and talk about the latest and greatest and the activity that's happening there. That might be a prime target for some extra credit. Maybe you can share that with your peers. So let's go on to the next slide. So the second chapter deals with high-risk pools, which is basically individuals that are uninsurable, those under 65, who either are not working, they're limited in what they can do for work, or they're receiving some kind of disability or workers' compensation. So they're the uninsured, and how do the states deal with this pool of uninsured individuals within their state? Continuing with the trend of making the course more current, the Power of Three for this week, for this particular chapter, is you can go ahead and discuss the current status of the state-run high-risk pools. Individual healthcare insurance policies. So who are the primary users? This would be a prime question to ask in a quiz. So it's primarily middle-aged individuals who are either self-employed or work for a small firm, usually less than 25 people. It's usually a way to cover insurance during a transitional period in someone's life where they leave one job and start another, or it helps to cover an individual that is otherwise uninsured for a particular time until they pick up state or federal benefits. This slide confirms what I just talked about, but it also points to, notice the 18 to 24-year-olds and the 25 to 34-year-olds. That's the lowest segment taking this insurance. So that can be tied back into the Affordable Care Act. And you can see that now they're going to be penalized if they don't buy insurance. So as that penalty goes up, that number should increase in future years. And maybe I'll pull in some videos on the Affordable Care Act and tie that into this presentation. So when you look at this particular slide, you can see that individual coverage is very small. It only represents a small portion of the market, only 6% for those 65 and younger. So at this point, I'm going to throw in a video from the .gov site that explains the marketplace and some of the plans that are out there. And I think that you as a health professional need to be able to explain that, because you're going to get a lot of people that are going to ask for your advice. The other thing I want you to focus on, and put some questions on the quiz on this, is I want you to understand the importance of dealing with pre-existing conditions. And that's where all the health insurance companies are concerned about throwing those people into the risk pool and how they're going to cover their costs associated with that. So let's go ahead and take a look at this video.
How to pick the right health insurance plan. How do you find a health insurance plan that fits your budget and meets your needs? A good plan protects you and your family at a price that's right for you. You can feel safe knowing that all marketplace plans cover a core set of essential health benefits, like checkups, having a baby, emergency care, prescription drugs, and more. Most marketplace plans must also include free preventive care, like shots and screening tests. And don't worry if you have a pre-existing condition. You'll see the same plans at the same cost as everyone else. You can't be denied coverage. Here are a few things to think about before you look at health insurance plans. Health insurance is a contract between you and your insurance company. You buy a plan, and the company agrees to pay part of your medical costs when you get sick or hurt. Although all plans in the marketplace cover a core set of benefits, the amount you'll pay will be different from plan to plan. In general, if your monthly premium payments are low, the cost of getting care, or how much you'll pay out of your own pocket for things like prescriptions or hospital stays, will be higher. And if you pay more each month for your premium, those other costs will be lower. Finding a good health plan means balancing how much you pay each month with how much health care you think you and your family are going to need during the year. If you're healthy and don't go to the doctor very often, then a plan with a low monthly premium will probably cost you the least. But if you need to go to the doctor a lot or you need a lot of expensive prescriptions, you should look at plans where the cost of getting care, or how much you'll pay out of your own pocket, will be lower. If you really need a lot of health care, spending a bit more on your monthly premiums will actually save you money in the long run.
Alright, so you watched the video, and I'm sure you could have already explained premiums and how to adjust premiums and how to look at premiums that fit your needs. But coming back to the slides here, the duration for individual care is very short, usually less than 6 months. And again, it's a transitionary period. This slide again emphasizes what I talked about at the very beginning of the presentation, that again, transitionary covers when they're uninsured, and is usually small companies and self-insured individuals that purchase this type of insurance. So the next few slides kind of go over the characteristics of this individual market. And historically, the premiums are relatively high compared to group rates because the associated costs and the risks that the insurance companies have to bear. The big player out there is Blue Cross. They tend to dominate this particular market in most states and have a national presence of roughly 50% for this individual market share. The Affordable Care Act is changing the landscape in individual health insurance. But years prior, you had to be very careful and read the fine print, because a lot of times maternity care was excluded. There was a 12-month waiting period on pre-existing conditions. So these insurance companies could actually pull you out if they found that you had a pre-existing condition and or change their rate structure. So that's a big game changer. Here's a concept we've seen earlier called loading ratios, and this again is the amount above and beyond the expected claim that the insurance in their respective markets have charged. So this is to offset the claims that they have to pay out on. We had a student that worked for one of the insurance companies, and they said that his company came into the the market exchange at a higher rate, trying to be a little bit higher than the competition, so that the competition ended up taking those individuals that had pre-existing conditions. This would be an excellent question to put on a quiz. But what are they trying to overcome? The potential for severe adverse selection. These next couple of slides, you just need to know from a historical perspective. Because of the changes of the Affordable Care Act, with the exclusion that they can no longer exclude pre-existing conditions, the government is also going to control the increase in the rate structure. So a lot of this is not relevant today. It's interesting to see the perspective at that particular time, as far as cost. A young female graduate student would pay about $100 a month versus an older gentleman that would pay $500 a month for the same type of insurance, for individual insurance. Okay, so we need to close this chapter out. There's a couple of items we still need to touch on before going into the next chapter, because it kind of builds from there. We need to talk a little bit about some of the high-risk folks. We know from previous chapters and some of the research that is talked about in this chapter that risks are pooled. The other thing I want to talk about, remember I talked about the fine print and how maternity care was often not covered. Well, all the marketplace plans cover that. But now, mental health and behavioral health is a little bit different. Yes, it's a pre-existing condition, but we're going to see a lot of information in the news and changes, because it depends on the state you live in and the particular plan you choose, what gets covered and what does not. And there's a huge cost associated with treating mental and behavioral health. Finally, the chapter ends with a discussion on the internet and how the internet affects premiums. And all these articles that were quoted in this particular textbook was prior to searching for rates on the internet. But we all know that when you search for something on the internet, you're going to look for the lowest price in most cases, unless you have a pre-existing condition and you're going to incur a lot of healthcare costs. So if you are one of those high-risk individuals, it makes sense that you're going to take the time to search for the plan that has the best benefit to premium ratio and covers your needs as far as a high-risk person. So closing out this chapter, in terms of the internet, you're not going to have a lot of people in the middle. You're going to have the high-risk people looking for the plan that meets their needs, and you're going to have people that are going to search for the lowest cost. So let's move on to risk pools. This chapter covers high-risk pools, particularly for individuals that cannot purchase private health insurance due to their health status, and it goes over what the states have done to assist them. All right, this slide goes over some of the characteristics, but typically high premiums, lifetime maxes, there's a waiting period sometimes to get in, and it's a big burden on the states and costing a lot of various states a lot of money, and some of them have actually restricted enrollment in the plans and have a waiting list. Again, lots of changes because of, the Affordable Care Act. So I know you've seen this slide again, but it does do justice because you've got the healthy outside the pool not jumping in, and then you've got all the pre-existing people. It would be interesting to see the statistics of the people that have signed up for the different marketplace plans and what their health status is. So you come on board, you fill out your information, and they look if they can funnel you off to Medicaid or the Children's Health Insurance Program. I think the biggest thing that's of interest that's different is their carrot is called the Advanced Premium Tax Credit. And I'd like you to listen very carefully to that because that's kind of an incentive to get people to take a plan, have a way to pay for the monthly premiums, and I'll go ahead and start that video.
When you shop for insurance at the health insurance marketplace, you'll find good quality health plans. And by answering a few simple questions, we'll be able to see whether you're eligible for one or more no-cost or low-cost insurance programs, like Medicaid, the Children's Health Insurance Program, and a new benefit called the Advanced Premium Tax Credit, which is available only through the health insurance marketplace. What makes the Advanced Premium Tax Credit advanced is that you get the credit each month, instead of waiting until you file your federal tax returns the next year. With APTC, part of your monthly payment is made by the federal government directly to the health plan in which you've enrolled. If you qualify, there are 3 ways you can apply your Advanced Premium Tax Credit. You can decide to spread out the credit equally across the entire year. You can decide to use some of your monthly APTC, which increases the amount you'll pay each month, but makes it more likely you'll receive a refund on next year's tax return. This may be a good option if you're unsure about your income. Or you may decide not to use any of your APTC during the year and simply get the money refunded on next year's tax return. Your eligibility and the amount of your Advanced Premium Tax Credit depends on the size of your household and your household income. Changes in life, like having a baby, getting married, or changing jobs, can affect the amount of your tax credit or even your eligibility. For instance, if you make more than you expected, your Advanced Premium Tax Credit will be lower and you might owe some money at the end of the year. But if you make less than you expected, you may get a refund. If you come back to this site and report your changes when they happen, you'll get your tax credit calculations updated automatically. If you qualify for the Advanced Premium Tax Credit, any way you use it, you'll still get a break on the cost of your health insurance to help you get the coverage that meets your needs and budget.
So as of 2006, there were 34 states to be eligible. You had to be medically uninsured. You have to be eligible under HIPAA. Also, you have to have exhausted your COBRA benefits. And finally, it's available for people with Medicare beneficiaries. This chart shows us high-risk pool enrollees by state in the year 2000. A little history: the first pools were created in Minnesota and Connecticut. And if you look at this list, you can see that the big players are Minnesota, Nebraska, Oregon, and Wisconsin at that time, and they were covering over 20% of their uninsured. Duration of coverage varies on a state-by-state basis. The coverage varied from state to state. The lifetime maximums were very different too. And I think I made that a question, but the average lifetime maximum under these plans was $1 million. Premiums set for the plans were set at the average premium for that particular type of policy out in the marketplace, and then they usually brought it up a little bit, and it ranged from 1.25 to 1.5 as far as the overall cost. Let me reiterate again that the states bear the risk for these plans, and they never collected enough premiums to offset the claims. The book cited, some research that looked at increasing the rate on the premium by 10% and said that it would have a reduction in enrollment by 19%. But basically, the states took responsibility because they felt like they had an ethical obligation to cover some of the uninsured in their particular states. The chapter closes with a short discussion on medical loss ratios. This chart does a good job showing the losses that these states were incurring in 1999. Let's pick Minnesota, for example. If you look at Minnesota and go across the chart there, you could see that they paid out $1.96 for every dollar of premium they brought in. And their states, look at the states above them, were even worse. This slide shows how some of the states offset their losses and covered their losses. They charged or taxed health insurers doing business in their state on a prorated basis for the losses, and they paid it out of general tax dollars. All right, that closes out these two chapters. I hope you have a strong understanding of the Affordable Care Act, and I hope that everyone makes an A on today's quiz. Thank you.